Okay, so it's a continuation of the market geometry that we've been looking at. Now, originally I was looking to do this as an extended webinar to go 1 to 2 hours. But then I realized the amount of work that's going to be involved and just having you guys sit around for all that with all the charting, I think would be way, 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 way too much. And especially if somebody's going to watch this as a video, it'd just be way too much overload. Um, so I'm going to break it down to today. We're going to look at more of theory of the patterns, and I'll draw out some of the numbers and how the patterns work. I'm going to show you one chart, and I'll show that on, I believe it has a Canadian dollar. I'll show you what it looks like on a particular chart, but most of the work, pretty much 99.99% of the work, is going to be us drawing it out and getting the numbers and behind all that and the pattern and what it looks like. So I think that is going to be the best route. And then next week we could do another webinar and expand on what we did this week, looking at actual patterns. But I just wanted to go through all this. So market geometry 3, in the past couple of webinars, we had went through trend range, we went through Elliott wave, went through some relationships, A to B, C to D, price relationships. And we're just going to continue to expand on a few things. We're just going to review Elliott wave real quick, review the Fibonacci ratios, price ratios, whether it is a retracement, an extension, a projection. We're going to go through that. And then we're going to go through the intro to market harmonics, or what they call market geometry, using the XABCD patterns, which essentially also people look at them as the bat, butterfly, Gartley, crab, cipher. I didn't include the shark. It's kind of a wacky pattern, so I'm not going to include that. And as I said, Fibonacci projections. And then we'll look at the three drives pattern. I'm going to keep it not so intense and not so long today. Enough that we could capture some information. We'll go through it step by step. And when we get through all the different patterns, then I'll upload it to the website. You get to look at it for several days. And then next week, we'll go into actual charts of everything that we discussed today, each pattern individually. So I think that would be a better way to spread out the series of webinars. So let's continue. And Elliott wave. Let's take a look at Elliott wave. In the past, we discussed that the market has a low, which will be a 0 point, and you have your 1, your 2, your 3, your 4, and then your fifth wave. So typically an Elliott wave would have 5 waves. From that, you would have traditionally an ABC corrective wave. Within the ABC corrective wave, many times you could take this fourth swing, this last pivot, and consider that a base to work from. And then on that ABC corrective wave, that actually looks like a harmonic pattern, something that we would call a Gartley or a butterfly, a Gartley pattern. Yeah, butterflies, you have bats, you have crabs. So this is more of either a bat or a Gartley type of pattern. And I'll get into those a little while. But on a typical Elliott wave structure, the 5 wave would have typically your ABC corrective wave, unless you have a very, very large fifth wave, and then you have another fifth wave of a fifth wave, like we discussed last week, a much larger time frame. And in that case, this retracement would look a whole lot different. So just keeping it basic, looking at right here, if we're looking at the Elliott wave structure, that ABC can actually be an A. This could be an X, A, B, C, D pattern also. So when you're looking at harmonics, you also have to look at the bigger picture of where in the overall structure of the trend that you are. And always looking for the D point. Now today I was looking at a couple of patterns in the afternoon, and the market was just flying so heavily from the FOMC they move so fast. So nothing was clean. It was kind of, I was looking to see if we had any patterns I could bring and show you today, but nothing was clean enough. So let's go to the next item. I'm just going to go through this again, the A to B, C to D relationships. All right. So this is called impulsive when you have an A to B, then a retracement from C to D. So you would have, this is actually called, many times this would be called a measured move, where your A to B is equal to C to D right here, meaning that if this is 10 points, that would be 10 points, or a derivative of 10 points. But they typically call this a measured move or an A to B, C to D, and this would be considered an impulsive A to B, C to D. Now corrective is what we just saw, is this retracement down in a trend up. So obviously this is coming from down here, like that, something like that. So where you're having your retracements in a trend, these are corrective A to B, C to D. So when somebody says we have an A to B, C to D pattern, well, you have to ask them, is it impulsive? Is it corrective? Is it going as a measured move, or is it just a retracement in a trend? Now, obviously this also can be a retracement in a trend. If your trend is so large, you can have something like this, where somebody would look at it as an A to B, C to D, but yet it's a retracement in an overall trend. That's a different story. All right. This would be if you were coming out of a range, or you're coming off of a swing low in a higher time frame. So just keep it simple. When you have such a large move down and you have this corrective wave, it could be misconstrued as a A to B, C to D, or a corrective A, B, C off that fifth wave like I just discussed in that prior chart, which we can go back and look at this one more time if I can get there. If you see what I'm talking about right here. Okay. So some people would look at this as an A to B, C to D impulsive, where it's just correcting of a larger term trend. So something to keep in mind. Okay, now in terms of retracements, and again, this would be what? An A to B, C to D corrective. Okay? And retracement levels, the market typically retraces 1/3 right here to 2/3, many times stopping at 50%. So you would have a 38 to 50% retracement of the move from low to high. So these are your retracement levels. Many times you get that type of retracement. Now, as we discussed in the Elliott wave, for instance, your low, you have your first pullback, the second pullback run up, and that pullback should not exceed this swing, this high, or 38% retracement. So many times you'll get that 38% retracement, and also it would match this A to B, C to D. This leg right here would be that equivalent. All right, this leg right here at the low, when it first comes off of a swing low, when the market first comes off of a swing low, you're more likely to get a deeper retracement because it's trying to make a retest down and it's failing to do so, and then it starts to drive higher. So the first retracement down off of a market low is deeper typically than the second run up and that second retracement. So we also have 707, you have a 786, and you have an 886. All right, on our website, we have a video called Commonalities, and I get deep into how you can arrive at 38%, 50%, 618%, 786, 886. So not to go into all those details, best just to go on the website, look at the video we did on the commonalities, and you'll see how we arrive and where the 786, 886, 707, 618, and 50% and 382 retracements percentages come from. So typically a 38 to 50% retracement right here is considered a shallow retracement, where a deeper retracement goes down 886 to 618 right here. So a shallow retracement is 38 to 50%, where a deeper retracement, you would have a rally and then maybe a little dip, and then it comes down this far before going up. That would be considered a deeper retracement as opposed to a shallow retracement on the first move down. And basically we have it all marked off over here. So that's a retracement in a trend. Okay, now projections of what we had just discussed, where you have your A to B equals C to D. Now, the trick is, here's a percentage. The question is there a key resistance up here somewhere that the market is watching? And in that case, your A to B may be 10 points. And then this may arrive at a 618, or say 6 points from this low to here. Okay, so maybe an A to B times 618 equals that CD leg, you see? Not always you're going to have a complete measured move up. Many people in the markets think that you would get a complete measured move up on an A to B, C to D, when that's not really the truth. You have to look at these derivatives also, and how they also relate to another part of the market. For instance, let's just say the market had sold off, all right, and you have some resistances up here like this, all right. So the market decides it's going to run off the low, come down, and come up again up to this area, all right. And we know that this was 10 points, and this is maybe 8 points. So we would be watching 80% or the 786, 886 of this whole swing. So rather than going 10 points, you can start watching resistance up at an A to B times 786 or 886 of this last swing, and therefore you're getting that relationship. Other things you're going to look at would be the high, the low, and then your retracement levels. Let's say this is a 38% retracement level from market high to low. Okay, from here to here, let's just say it's a 38% retracement, but this here was 10 points down, up to this point is around that 8 points. So again, you're still looking at that A to B times 786, 886 would equal that C to D leg, you see? So you want to be careful when you're looking at this, because a lot of times in books or out there in the marketplace, people call that a measured move. And although, yes, typically it's called a measured move, it's not really a measured move all the time. Sometimes you'll fall short, maybe a 618. Now, what if your 38% retracement was up here, and this was 14 points off the low, off that swing? Meaning that this right here, let me just draw this out. This right here, this swing was 14 points. This was 10. It would still actually qualify as a A to B, C to D, but it would be A to B times 141% equals C to D. So although this swing up is much larger than this first swing down off the low, that still qualifies it. So this is what they call a projection. All right, a projection. So typically, as I said, a lot of times you'll see that as 100%. Sometimes it falls short, sometimes it's further. It all depends where resistance is and what. And hold on a second. Hold that talking. And it depends where all the prior resistance is and retracement levels, where you would get those A to B, C to D projections up. Now, given the fact, let's just say that the market also, let's just say this is an all-time high, and now the market is making new all-time highs. Well, there's no limit as far as it can go. I mean, there really is no limit. We've seen this before, where market can continue. So if a market is in an impulse going strongly up, When you look at projections, you're not looking at areas where you would short, you would look at targets where you think the market can go. So yes, if you had the same condition, this would be 100%. That's typically where you would first want to look at. Once it starts exceeding that, then you can start looking at these other levels. But keep in mind, if the market is at a new all-time high level, you don't want to fade that. All right, you're just using these projections as areas. If you, let's just say you bought the market and you wanted to get out someplace higher. Okay. Now, what's an extension? Let me draw this out for you. An extension is basically you take in B to C right here, and you're extending it up. So meaning from this point right here, A to B, that's your impulse, okay, that's your up. And then from here to here down, let's just say this is 10 points. So an extension is A to B times, oops, this A to B right here, A to B right there, times a percentage. So times, let's just say 1618. 1618, you would look at roughly 16 points up on this move from C to D. All right? Or C. I'm sorry. Let's get rid of this. Here, here, here. So A to B is 10 points times 1618, which is 16 points. That would be considered an extension. So just like you have a projection from here to here and from here to here, this swing down also qualifies and is an extension. And you'll see how all this plays out when we start looking at the harmonic patterns, how it all comes together. All right, so let's take a look one more time. So market runs up 20 points, comes down 10, and then starts extending up, and we look and we say, okay, it's a 1618 extension, and this is the area to watch, and how many points that would be? That would be 16. All right, so that's an extension. All right, so let's look at some commonality zones and how we start to look at this and start to tie it all together. Now this looks a little bit confusing, and I'm sure it is confusing if you don't understand it. That's why we're going to break it down piece by piece. So the market, let me draw this out with my arrow. Market went from low to high, and then you had a retracement. Then it went from that low to the next high, and then you had a retracement. It went from that low to that high, and then you had another retracement. Well, a couple things we look at. Let's just say we're starting with this area here. So if we take this area to this area, we look at and we find a retracement, that's fine. But if we take this low to this high, we look at, say, a 38% retracement. If we take this low to this high, we look at it and say we find a 618 retracement. And what that does is give us two levels of commonality, because the larger swing, let me just draw this up, the larger swing is a 38%, and the smaller swing is a 618%. And they both land right in this general area, and we call that commonality. So in this next example that we have drawn out, you could see here, from this low to this high, down 38 to 50%, and from this low to this high, down 50 to 618%. So you have commonality in the zone. So that's the first thing you would look at, is where commonality is, where is support. The next thing you would look at is your extension or your projection. So how would you find support here? Well, the first thing we would do is look at this swing down versus this swing down. Maybe this is 10 points. Maybe this is 10 points that come into this area over here. The next thing we look at is this swing up. All right? And then we look at that swing up versus this swing down, that extension. So you have retracement, you have the projection, and then you have your extension, you see? So they all work together hand in hand in finding areas of support and resistance. It just takes a little time for you to draw it out when you're looking at charts. All right, so let's look at this again. So we're identifying that retracement. We know that the last swing down is based on this swing down and this swing down, right? This whole area is the same as this. And the two things we look at on that retracement is on that A, B, C down, we look at the high to A and from B to C as that projection. And then we look at A to B with the percentage down, gives us that extension. So basically we look at areas that you want to look at as support, and you could tie all this together. Now, obviously is on paper and it's theory, and it's a lot easier if you're not physically drawing it out. You're just marking it down on paper. But when the market's moving, you have to be on top of this. All right, so something important to watch. We're going to start seeing a lot of these type of patterns as the markets progress now into the year. These patterns are going to start opening up across all the markets. We just started the new year. We're still into the first couple of weeks, and we're starting to see the markets open up. You know, during the winter, into the new year, they close up for the last month. In that first month, they start opening up again, and then you have a nice run of patterns throughout the course of the year, and that's what we're starting to see. So this is really important now, because you're going to start seeing a lot of these type of patterns, which they're already starting to do. All right, so it's very, very good to start practicing commonality zones. Now, how do we tie in commonality and harmonics is important also. Where you have a low, you have a high, and you have a retracement. That's that retracement zone. The same chart here, low, high, and retracement. Now the trick is you want to put in those harmonics. So let's just stop a second. Let's go back to the prior slide. And if I was to take this low and we would start drawing in those harmonics, you can see how all this starts to work out together. You see that? All right, so we're going to start looking at how they kind of intertwine, market harmonics intertwine with basic market geometry in terms of retracement. So market geometry is typically, as I said earlier, we have X, A, B, C, D. You're always looking for X and always looking for D. The larger structure is what? This whole retracement down from A to B, this whole retracement down, you're looking for where support can come in. Commonality from this low where retracement is. So if we look at it on a harmonic type of level, we take this swing down, we put this first rally up, pull back down, rally, down, and then we start looking at this in terms of levels of what percentage from X to A, what percentage from B to C down to D, and we start connecting these zones, and we start creating these harmonics, whether it's a bat or a Gartley, and they come into play also. So there's two types of work in one, where you have basic market technical analysis from the early 1900s. Then you got the Gartley, and you got all these other type of patterns, these harmonic patterns, which tie into that. So they all work together. And a lot of it is based on the Elliott wave. If you really think about it, if you look at the work we've done in the past several weeks, a lot of it is based on Elliott wave due to the type of patterns that it has. All right, so I drew it out again, as you could see here. So we got the harmonic Gartley pattern. And that's what it would look like, drawn in. Okay, I'll drink some water. All right, so next pattern, Next thing we'll look at is we're going to look at the Gartley pattern and what it's supposed to look like. So everything starts with a X, then we go to A, then we go to B, and then we go to C, and then we go to D. Now, I'm going to draw out this pattern, I think the next pattern, but let me just stop for a moment. Let me stop for a moment and show you on, say, a Forex chart. I didn't mean to do that. I didn't mean to do that either. All right, let me fix this. All right, let me just show you on this particular chart here. All right, so when you're looking at charts themselves, this would be considered an X, A, B, C, D. This would be considered a butterfly pattern. All right, so we're not going to get into this right now in the actual physical charts. I want to go over more on theory on what it looks like. I'm not worried about all these crazy price bars right now, because if I don't get you the actual patterns and the understanding of them, then we're not going to make much sense here for you. So let me shut that off. Excuse me. Can you believe it? Here it is. There we go. Okay, let's go back into the Gartley pattern. Let's go back into the analysis of that, and let me put on my full page again. There we go. All right, so we're not going to get into the actual charts tonight. We're going to go through the theory, and then next week we can go through the physical charts, but I was just kind of showing you what it would look like on a chart. So what do you guys see here? Let me just make sure we're seeing the same thing. Okay. All right, so on a Gartley pattern, and we're always looking for, on market geometry, X, A, B, C, D. Market geometry, X, A, B, C, D. All right, that's market geometry, and then you have harmonic patterns that go with it. Basically, as long as the geometry works, it's fine. Okay, so on a Gartley pattern, your X goes up to A. You have a rally from X to A, and then your first retracement down, which is this is your B, should be a 618 retracement. So this area right here is a 618 retracement. So this is a 618. So from X low A down to B is a 618. Now going from B up to C, the market should be a 382, 886. So this area right here, from this market low, from the market high up, that retracement up can go anywhere from 382 to 886. What that means is, let's just say it stops here or stops here. Anywhere in here, if it stops and turns down, that still qualifies the pattern. And then when the market goes from C down to D, that's that extension. That's that B to C down. That's that extension we were looking at, and that's that 1272 to 1618. So the market extension goes from B to C down to D, a 1272, 1618 of that B to C. Okay? And then right here, 786. So Gartley should not go more from X low to A high past 786 into the D pattern. And that creates a perfect Gartley. That would be a bullish Gartley pattern. So if you recall, when we were looking at the trend going up, so you got a trend going up, and then it makes that A, B, C corrective wave. Well, you can look at it in terms of that Gartley pattern that we're drawing out right here before it continues, you see? That's one way to look at it. Off a market low, this would be a second way how to look at it, where this would be the base, and the market would take off. So you're always looking for D, always looking for X. So X up to A is a 786 retracement, but the criteria is that first swing down off the high, and that A to B, C to D wave is a 618, and then you have that 382 to 886 swing up from that A high, B low to C, and then on the way down you have a 1272 to 1618 extension from B to C. Now they don't take into consideration the A to B, C to D wave in terms of length. They don't take that into consideration in the Gartley, where maybe this is 10 and this projection is maybe a 1272 of it, but they don't consider that. That would be a Gartley pattern. Now this is the butterfly. That's what I was just showing you on the other chart, but I turned the chart off, where the X pattern, and let's look at it here, the X pattern was here, and the market sold off down to A. Now, on the way back up, on the butterfly pattern, your X to B, this is a 786. 786% from X, A, up, B. So 786. I know my drawing isn't the best here. And then from A low to B high down, you're looking at a 382 to 886. So there are some spaces or variables where the market has room that can go a little bit deeper or a little bit shallower, but as long as the harmonic pattern is available and working and the structure is there, then it's fine. Now, the main thing with this butterfly is this next swing up. All right, so you got your B to C. Now this is a 1618 to a 2618 extension. So from B to C up to D, this is your criteria. So the criteria is you're taking B to C and you're multiplying it by 1618 to 2618. We're also taking the X high, low, A, and then measuring up a 1272 to a 1618. All right, so you're looking at that on the way up also. All right, hold on one second, gang. Hold on one second. All right, so we're just going to go through the patterns here, and one step at a time. Let me just get my pen is not working. All right. So basically, this is a butterfly pattern, and that's kind of what you're looking at. You're looking at the market swing up. You're looking at this swing up. You could look at this swing up if you choose to. Anything that where geometry works, where the market has geometry, then you could tie it all together. And as long as you find some commonality, essentially, as long as you find some commonality, that's really all you're looking for. You're looking for all that commonality to work. All right, so where in a trend, if this is going like this, you would look at a retracement zone. Well, where's that commonality off of these swings it's the same thing. You're looking at this just a little bit different of a way compared to how you would look at it in a straight trend up. Okay, the bat pattern. Bat pattern. Okay, now the bat pattern is similar to a Gartley pattern in that this X down to A up to B is a 382 to 550%. So from X down to A up to B, it's a 382 to 50% retracement, and that should stop it right there. On the way back down, it should hold a 382 to 886% of that market swing up. So from A to B down, you can get a 382 to 886 retracement of that swing. So as long as this criteria now is holding, we then now look up at this criteria coming up into D. So D would be an 886 of the X A up. So let's take that little swing here. Down here, up 886% of that swing. And that would be your bat pattern. Now, your B to C to D would have that same 1618 that we saw in the other pattern on that butterfly to 2618. So B to C up to D, and then you have that XA up to D, and then you have the BC up to D. You have all this put together, has your areas to watch, and that's your bat pattern. Similar, like I said, to Gartley, except that Gartley comes in at about 786. This comes in a little bit further, and I guess somebody, whoever wrote a book, said, you know what? Rather than having one pattern that takes into considering both zones, we'll just make two different patterns. I guess they made an extra chapter in a book. As I said, as long as the geometry works, you can call it whatever you want. You can call it the Obi-Wan Kenobi pattern, as long as the geometry works where you have commonality from all these different retracements and extensions and projections. That's all you're looking for, really. Chris made the Obi-Wan Kenobi pattern. All right. So the crab pattern, similar to that of that butterfly we looked at earlier, has a much longer type of pattern, where this swing here would be 1618. 1618 down from here to here down, and then from your B to C, and it's rare you see this, it's a 224 to 3618 extension. So the crab pattern has a much elongated type of swing down into your D area, and you do have it. And there is that type of structure. It's not as common as the other patterns that you see out there. So not to get into too deep with this one, but I'll just mark out what your levels are. So let's try this again. From X to A, you got your 382 to 618 retracement. From X down to A up to B, and from A to B down to C, you're looking at 382 to 886 retracement. From B to C up, it's a 224 to 3618 extension, and then from X to A up, it's a 1618 extension up. And that's giving you your D pattern in this whole harmonic or market geometry, your X, A, B, C, D in this particular pattern, this crab pattern. Now there's another pattern called the cipher pattern. All right. Let me just show you I just want to show you what the structure looks like, because you don't have to get so deep into the numbers as long as you have this particular area and this particular area matching up. A lot of times you'll see this. You'll see the X, and this is a newer pattern. It's not that it's newer. people find these patterns from time to time, but there's a couple different ways to look at this, and I'm going to draw this out. One is your X, A, B, C, D, and this right here is 1272 to 1618 extension from your A to B up. Now, the trick is that this C made a new high above A, and then that C to D comes below B, but stays above X. So you have roughly a 786 retracement zone, and you have your extension down, your 1272 to 1618 extension on your D pattern. And that's called the cipher pattern. There's also, you could look at it where you have your X, A, B, C, D, which the D pattern is below your X and below your B, and here is your A. All right, and this is C. So a couple different ways to look at this. This cipher pattern is within the past couple of years. People are starting to pick it up. There's a gentleman, his name was Bryce Gilmore. He's been doing it for 5,000 years. He's kind of retired at this point. Him and Larry Presavento, these are old-time pioneers with this stuff. They pretty much always had these patterns. The X, A, B, C, D, except that somebody came out and put it on the internet and said, okay, they discovered it. There's really no new discoveries at this point in the markets. So your cipher, or what they call it out there, if you want to do some searches, is an X, A, B, C, D, whereas you have another market geometry with your X, A, B, C, and then the D point is below the X. So that would come down like this. All right, it would look something like that. All right, it would look something like that. All right, so a couple different ideas, more optional type of patterns to look at. And as we're coming into the 5 o'clock time frame, we're running at about 40 minutes, 45 minutes is what I was expecting to do. You have that, what they call a 3-drive pattern. You'll hear this in the marketplace a lot, 3-drive pattern. And the 3-drive pattern is 1, 2, 3, simple. But what really is the 3-drive pattern? It's your 0, 1, 2, 3, 4, 5, your Elliott 5 wave. That's essentially what it is. And remember, you can have your harmonic pattern, your ABC corrective wave, which essentially becomes those harmonic patterns that we just discussed. All right. Boom. Okay. So looking way back, it all comes down to Elliott wave. It all comes down to price structure. It all comes down to market geometry. And what we're going to do is cut from this week. We're going to cut this video off, and next week we're going to look at doing actual price charts with actual price patterns. So I'm going to go back and look at history of charts and pick out a whole bunch of patterns, all the different ways you could look at it. And then next week, because we learned this week what the harmonics are, what the patterns look like, we're going to match up the pattern theory with the actual patterns and look at all the extensions, the retracements, the projections, and how everything came together. And we'll start looking at it that way. So that way you have a good series multiple videos that you could look at from week to week to catch up on what market harmonics are, market geometry, and basically what they call the Elliott wave, or these XABCD patterns. So there's a million ways to look at it, and a million ways to slice a cat, a million names they could put to it, but it all comes down to XABCD. And with that, we're going to end this week's thoughts on market geometry. And next week, as I said, same time, same place, 4 o'clock next Wednesday, we're going to get deep into the actual price chart patterns with, for Forex, for futures, we're going to get into it. We're going to look at maybe some oils, we'll look at gold, we'll look at commodities, we'll look at all sorts of stuff that have these price patterns, and I'll show you how it all ties together. Actually, I think I may have I'll have something next week. I have an email that came in from a friend of mine who does a lot of work on that, and he sent it to me. So I may have that email. I'm going to check it. It's on another computer, and I'll include some of his work. I'll see if I can show you some of his charts. and he's an older analyst. But all the bigger players, all the big market analysts use market geometry. It's what's been around forever. It's going to be around forever. You can have your moving averages and all that, but static geometry is pretty much where it's at. Market likes to relate and attract to exact price points. It just does. It likes 50%. It likes thirds. It likes halves. It likes relating to prior swings, the exact percentages and prices, and finds, okay, it hits a level and decides whether it's going to stop or go, but they attract. And you'll notice that within any type of a trend, you'll see that, whether it's a dinky trend or a very, very large trend. And if you look back at last night's video that I put, the opening play video, if you look at that video, let me see if I can show you. I want to show you something in terms of price. Okay, I'm going to pause the video for a moment. All right, so resuming the video, let me get my screen up. All right, this happened in the overnight session. Yesterday we were looking at, well, last night actually, when we did the video, we looked at the 0, the 1, 2, 3, 4, 5 Elliott wave. If you looked at our opening play video, then we had our A, B, C corrective wave up. And we were watching for a rally up on this time frame, and we were looking at within this time structure. So if you go back and look at the time that we were looking at of how price and time works, we were also looking at a 36% move off this low, where it only went around 34 points. The point is, next week we'll start looking more at also time, on a much higher time frame. On the little time frames, it's very, very difficult. We'll look at time and we'll look at price and how they all tied together. As an example, you can see 36 points up from this little low. So this would be considered an A to B, C to D relationship. It would also be considered that right here, remember we talked about earlier, that A to B, C to D up, or that ABC corrective wave. And you see how this wave was longer? So let me get rid of some of this jewelry. Okay. We'll just look at a real-time chart. See this right here? Then it came down, and you see that is how you have that, when we discussed earlier, when you have that A to B, C to D, how that sometimes that C to D can be a much greater percentage. All right, so let's take a look. Let's just take a look and see how that worked out in terms of percentages. I know we were looking at the harmonics a few more minutes before. Okay, let's get rid of this. So how we would do this, and this is just an introduction of what we're going to do next week. If I can get my all right. So what you do is you take this swing, okay? And let's do something like this. One for one. Okay. All right, folks, just hold on a second. My computer's somehow, my chart's it's a very, very high time frame. All right, here it is. So let's take a look at this real quick, and then we'll call it a night. Something we could look at going forward, which we will. Okay. So if we took this swing here down, and remember we looked at projections, this swing right here is actually a 141 percentage of this swing up. Okay. Now if we look at the harmonics of it, if we look at this on a harmonic level, let's take a look in what we see. And let me change the price bars so we can look at this a little bit easier. All right. And then next week we'll get into some serious chart work. Okay, if we look at it something like this, it would be a butterfly pattern on that type of time frame where you have that retracement. So lots of little things we're going to look at, and it just takes time to go through this, as you can see. And we're coming into about almost an hour worth of charting today, so not bad. All right. And the other one you would be looking at would be the high down and then a retracement of that swing. You see how that all works? We'll get into this next week. Same time, same bat channel. Gang, have yourself a great night. I'll see those of you in the live trading room. I'll see you in the morning. And